All right, we're live now, and today I'm honored to interview the top investor and developer in Pittsburgh area, Josh Adamek. Josh, welcome to my show, and I'm excited to interview you today.
Thank you, Roman, for having me. It's an honor to be here. I appreciate the invite, and I appreciate the warm introduction, saying I'm the top investor and top developer. I think that's that's a little bit of a stretch, but yeah, you know me, I just do my thing.
I know Josh for years, and you showed yourself as a successful investor, and I'm sure you have a lot to share with us in today's interview. I suggest us to focus on long-term rentals and positive cash flow from rental business. So with your experience, I know you have over a decade of experience investing in real estate and having long-term rentals. Let's start from giving your opinion on long-term rentals. What's the benefits of it? What the rental could cash flow, and how to calculate the cash flow?
Okay. Yeah, no, appreciate that. And yeah, you're right. I mean, I've been in the business a long time, close to 20 years now. I've done, more or less all aspects of the business, everything from rental properties, low income type rental properties, what we call, the B-class rental properties. That's a big big part of our portfolio is, we call them regular houses, regular neighborhoods, B-class properties. So we've done that. I've done a lot of wholesaling. I've done a lot of flips, renovations, infill, new construction, land assemblage, land development, acquisition, land assemblage and consolidation and subdivision. So, and sort of everything in between. But, what I've really honed in on over the last couple of years, the last 4 or 5 years, to be more precise, is long-term investments, and that comes to us, to Avid, my team, through owning rental properties. And basically what we do is we operate under a private equity model, where we work one-on-one with private and institutional investors to create and manage portfolios. So we offer a service to our investment partners, where we create and manage portfolios, and that's primarily portfolios of single family homes in B-class neighborhoods. And our goal, our strategy is, the focus is safety and security with these investments, with these portfolios. So we're not doing anything speculative. We're not banking on, a certain area being the next hot spot in Pittsburgh. We're not buying, based on, with the assumption that, Uber or Google or, one of the big tech companies is going to land in that neighborhood and values are going to go up. It's just, we buy a bunch of regular houses, regular neighborhoods. And what I've found over the years is, when you're in the business, when you're a real estate investor, passive income and positive cash flow, when you're an active investor, positive cash flow and passive income is an absolute must. Right now, we're in an up market. We're towards at or near the top of a market cycle. So, regardless of what strategy you're doing, for the most part, whether you're flipping, wholesaling, working as an agent, or buying rental type investment type properties, there's money to be made. But in the event of a market correction, more than half of those income streams go away or become severely affected. So where we invest is regular houses, regular neighborhoods, because our investment partners, they look for safety and security. In what we provide in our portfolios. So we invest in a property type that will perform regardless of market conditions. And actually, the way we have our portfolio set up, they perform a little bit better in a down market. So, I know that's a lot of information thrown at you, but I had to kind of give you the backstory leading up to the answer. So, that's where we're at, just regular houses, regular neighborhoods.
Yeah, Josh, tell me more. I hear this a lot from you. Regular houses, regular neighborhoods, but what the criteria of these regular homes? Can you be a little more specific on that?
Yeah. So the criteria that we look for when I say regular houses, regular neighborhoods, regardless of what market you're in, we're in Pittsburgh. My office is just north of the city, just outside of the city of Pittsburgh, about 10 minutes north. So our buy box is, our particular buy box is a 45-minute radius from our office. So we buy single family homes in and around the Pittsburgh market. But regardless of what city or what market you're in, a regular house, regular neighborhood is median price points for the area. So in Pittsburgh, median price points right now, last time I looked, they were like, the median price point was $183,000. I think that's up over 200,000 now, 212, 213, something like that with the market that we're in. But regular houses, regular neighborhoods are median price points for the market that you're in. For us, my description is grandma's house. I'm a Pittsburgh guy, born and raised in Pittsburgh, and most myself included, but most everyone that, a lot of people that grew up in Pittsburgh know grandma's house. So it's like, it's the 3-bedroom, 2-bedroom, 3-bedroom, 4-bedroom brick ranch or 2-story that was built in the 50s or 60s. That's in, a B-class neighborhood, working class neighborhood, that, market value is anywhere from, $125,000 up to maybe $225,000.
Perfect. That clears that a lot. So just tell me about how you find these homes. Are you searching MLS? Are you getting deals from wholesalers? Are you trying to find the deals yourself?
We wave a magic wand and they appear. If it were only that easy. But yeah, I mean, for sourcing new deals, sourcing new properties, I mean, especially in the market that we're in, the an up market, there's a lot of competition. Everybody wants to invest in real estate right now. They see all the highlights, real estate's great, the markets are up, rents are up, price points are going up. I mean, that's the world that we live in right now, but which leads to more competition when you're trying to source deals. So we work many different strategies. I mean, we buy a majority of the properties that we buy and put in portfolio come from off market type deals, where, we're doing our own marketing in house. We're going, we're getting in contact direct with the seller, whether that's mailers, direct mailers, social media, click funnels online, different lead generation sources that we have set up. We do buy a lot from wholesalers. There's a lot of wholesalers out there that we buy many properties every year from those wholesalers. And then, we look at the MLS every day, out of the properties, out of the number of homes that we buy every year, a small percentage of those actually come from the MLS, even though we look at MLS type properties every day. We just don't, we have our criteria, we have our buy box that we look for. And, we don't get caught up in the highest and best and, going outside of our buy box just to get a deal. So, when we get into the MLS type properties, typically when it's a home that meets our criteria, there's, 50 other people lined up that are ready to buy it too. So, but we are able to source some deals off the MLS, in the, way to go about doing that is, working with someone like yourself that's an investor friendly agent that knows how to, source the deals that are on the market and, send them to your clients.
Yeah, perfect. Yeah, we all struggling in this hot sellers market, finding these deals, and having as many lines in the water would be the best advice that I would give. And that pretty much your words pretty much proving this strategy, having as many lines, MLS, mailers, wholesalers, and
Yeah.
anywhere the lead comes from is not a bad way to get it.
Yeah, you
Perfect.
gotta work many different angles because not any one particular strategy is going to work forever. When we started marketing heavy, I want to say it was back in like 2012. We were doing a lot of direct mailers with the yellow letters. They through the website that we use, it's yellowletterscomplete.com. And it's a handwritten yellow letter that looks handwritten, but it's printed out on a machine. It's actually pretty cool. If you check out their website, they have like these giant machines that hold pens that it's all mechanical, but it makes it look like a handwritten yellow letter. And we sent a bunch of those, and we had a super high conversion rate, and that was back in like 2012. And that's because, we were one of the only ones doing it. And we were doing it on a large scale, to entire neighborhoods. And so we were getting a higher conversion rate, but now, we're in an up market, and, a lot of people are sending mailers, sending letters, sending postcards. So, and rather than a 10 or a 12% response rate, you might get a 2 or 3% response rate. So, the strategies, one strategy that works today, might be obsolete or might have, far more competition, 2 months, 2 years, 3 years from now. So that's why, we work many different angles with, with sourcing deals, whether that's our own marketing, buying from wholesalers. I mean, that's another thing too, like with working with wholesalers. If we go back 2-3 years ago, we were the go-to for the go-to buyer for a lot of wholesalers, where, we have money in the place, we're ready to buy. And, we would call our list of, 10, 12 wholesalers every week and say, hey, what do you got for us? If they haven't already called us and said, hey, I got a deal for you. But now, again, I mean, there's a lot of competition. So, a lot of the wholesalers that you work with, they just want to send it out and get the best price that they can for the property. But then again, to follow up on that too, like advice for a wholesaler is, just because somebody's willing to pay a crazy high number, doesn't mean the follow through or the close is going to be there. So, we end up sourcing a lot of deals from wholesalers where their buyer has backed out, and they got to close the property in 2 days or 3 days or a week, and they'll call us up and they'll say, hey, you still interested in this home? It's like, yeah, I would have bought it, I wanted to buy it 3 weeks ago, and they said, if you're still interested, can you close on Friday? And it's like, Tuesday or Wednesday, and it's like, yeah, we can. We have the ability to do that. Of course, title work's done and they're ready to close, but we probably do that, I don't know, at least a half a dozen, if not a dozen times a year, where, buyers, wholesaler puts a property out there, buyer comes in, commits to paying some stupid price, and then, their follow through, their close isn't there. They back out, with a contingency, or, back out when they get to come up to the closing table when they don't have the funding available. So big thing is, like, recommendation for wholesaler is, your highest price isn't always your best deal. I mean, make sure that the buyer that you're working with, has a track record of closing and getting to the table and has the funding available. And, let's face it, I mean, proof of funds, unless it's a bank statement, cash in the bank is, somewhat useless. I mean, if you're getting a proof of funds, make sure it's from a credible source.
Right. Yeah, that happens to me a lot.
Yeah.
Wholesalers trying to get the best money out of the deal, and then everything falls through, and then coming back either to me or to my clients if I represent them as an agent. And it happens exactly how you just explained. But since we're discussing the positive cash flow on rental properties, let's focus more on numbers.
Yeah.
Well, first, what would be the ideal cash flow on ideal home that you own?
Ideal cash flow. I mean, we have, as I mentioned, we have a buy box that we have certain criteria that we look for in each property that we buy. So, we look for a minimum of 30% equity, and then we look for a minimum of a 12.5% cash on cash return on that. So, that's dollar amount, like cash flow. It depends. I mean, it depends. We look at the calculation based off of the cash on cash return. So some properties we might be, 85 to 100,000 all in. Some homes we might be, 150,000 all in, and that the dollar amount on the cash flow is going to vary, based on our all in. And then, we look at the deal as a whole, where, some properties we might buy, we might be willing to, stretch a little bit on one part of our criteria if another part of the criteria is really strong. So for example, if, we have an opportunity to buy a home that's in, a really solid home in a really nice neighborhood, we might take a little bit less cash flow on that property if the asset is better quality, or there's an equity play or something like that. So I know the old saying is, or the old a lot of people say it's like, oh, we'll shoot for $200 a month cash flow after all expenses, or shoot for $300 a month cash flow after all expenses. Well, that's assuming that, there's leverage on the property, and, you're using bank financing and stuff like that. So, everybody's criteria is a little bit different, but, we look for quality assets, regular houses, regular neighborhoods, solid homes that are going to be good long-term investments, with some equity, and then, a decent cash on cash return.
Makes total sense. And since we're talking about this 12% and cash on cash return, I know Airbnb becomes more and more popular way of capitalizing on the maximum cash flow. As it's twice or three times higher than the conventional renting. What's your thoughts on Airbnbs, and what's your thoughts on comparing these two, and why you invest in conventional rentals versus Airbnbs?
Right. So, when it comes to long-term investments, we look for, like I said, just regular houses, regular neighborhoods. I have seen, a lot of opportunities in Airbnbs recently. And, I'm sure you've seen like the homes that we build to sell, Mount Washington, places like that, the modern homes, rooftop decks, with the higher end finishes. We're currently in the process of evaluating a couple of those properties that we're building to keep them as Airbnbs. So that may be something that we're working on here in the near future. But when it comes to Airbnbs, I know that and this is just my opinion, I know there's a lot of people that do Airbnb and do it very well. The one thing you have to be aware of is yes, I mean, you can get huge returns on Airbnbs, but the thing to be aware of is, when it comes to Airbnbs, you're dealing with the most difficult part of being a landlord, 5, 6, 7 times a month, as opposed to once a year or every couple of years, which is turnovers. So, when you get into Airbnbs, when you're looking at those properties, those type of investments, my suggestion is, try working with someone that is, what's that called? A super host or something like that, like an Airbnb manager, somebody that has the team to manage the Airbnbs. And this is assuming that you want to do it on some large scale where you want to have more than one or two homes, or two, you're going to need a team in place to manage that, because you're going to be managing turnovers on a regular basis. We've all stayed in Airbnbs, and that, like, when you go to the home, there's the welcome packet where it says, like, this is how you turn on the TV, this is how you turn on the stove, this is how everything works. But in reality, like, a lot of people that stay at Airbnbs, like, they just want to call somebody and, like, hey, how does this work? Or, hey, this isn't here. Or, hey, what do I do? And, unfortunately, or fortunately, unfortunately, however you want to look at it, like you have to have somebody available to field those phone calls. If you're not fielding those phone calls and keeping your customers, or, you know, your residents, which are ultimately your customers, happy, you know, you're going to start getting negative reviews, which is going to put you on the you know, downside of the Airbnb world. So you know, again, like when it comes to, I don't want to say it's like an apples to apples comparison, but same thing when you look at, like, you know, low income rental type properties. Like when you look at a spreadsheet of low income rentals, it looks great because, like, you can buy a house for $15,000 and it rents for, you know, $800 a month, and everything looks great on a spreadsheet. But in reality, like when you're looking at low income rentals, like those are the most difficult properties to manage. You get higher turnovers, you get more damage. You know, you get you tend to get more non-pays and things like that. So they look great on a spreadsheet, but in reality, you know, there's a lot of work in low income rentals. And I can say that because I've experience in that. You know, and then when it comes to Airbnb, you know, it's a high, there's a lot of work there. You know, it's a job. So yeah, you might be able to take a home that you're going to get, you know, 3,000. If it's a higher end home, you might get, you know, 2,800 to 3,200 bucks a month as a rental. And, you know, if you're able to pull, you know, $500-600 a month, $500-600 a night through Airbnb at 60% occupancy, you know, whatever those numbers equate to, you might be able to gross, like, you know, $8,000 or $9,000 a month out of that property. But along with that, you know, comes a lot of work and responsibilities. So just going to make sure that you have your team in place to deal with that.
Yeah, it's just a different business. That's what I hear. And
Yeah.
it's not for everyone. If you're an investor on that scale, when you have as many homes as Josh has, it becomes overwhelming trying to increase the cash flow, and the extra work will come with it. It totally makes sense. It's a good way of increasing the cash flow, but it comes with a lot of extra work. Make a little sense. Well, Josh, thank you so much for participating in this interview. You gave so many tips. I don't want to overwhelm my audience because you shared so much useful tips and strategies today. I want to say thank you again for joining, and I hope to get together with you on the next interview in some time.
Okay. Well, hey, if you don't mind, you got like a few more minutes?
Sure, go ahead.
Okay. So you said that I'm going to share this over my platform. You know, I'm going to put this out on my YouTube channel and my social media. So,
Sure.
you know, not everybody in my network knows who you are. So, you know, let's take a minute and talk about that, if you don't mind.
Absolutely. Well, my name is Roman Ivanov. I'm a real estate coach for Tom Ferry International. I also licensed as a real estate agent in Pennsylvania and Florida. I have interest in real estate, especially in Pittsburgh. It has tremendous potential with flips, with long-term holds. I've been investing as long as I remember, Josh, I think from 2010-ish.
Something like that. I think we met back at Acre, right? Yeah.
Yeah, it's been a long time.
We met at an Acre meeting initially, right?
Yeah. Acre meeting.
Yeah.
Initially, we met at one of your flips.
Okay.
And you had that mega open house with wine. And
that's right. Yeah. Okay. Okay.
So that's how we met, and we've been in touch for all that time. And I've been watching Josh's growth with his business, building all these crazy apartment complexes and high-end homes, and I'm very, very excited for your growth.
Yeah, thank you. And then you had mentioned you're in Pittsburgh, but you're also set up down in, is it Miami or Fort Lauderdale? Okay, Miami. So you're you guys doing any investing down there, or are you just mainly working as an agent?
Well, here is a different thing compared to Pittsburgh, especially with long-term. Here, it only makes sense to invest in long-term when investors put in as Airbnbs, as far as the single-family homes, or buying high-rises that start from 10 million up. 10 million here is not that much money. For 10 million, you can get 6 units and you're lucky.
Yeah.
So it's a different investment game, but the weather is nice. To be honest, we have 85 degrees and sunshine right now.
Right.
So that's also a great benefit of living in Florida. But I'm in Pittsburgh literally 2-3 times a month.
Okay. So offline here, we talked about Airbnb. Offline, we're gonna have to connect on some of the Airbnb opportunities down there.
Absolutely.
Yeah. So I appreciate that, man. I just wanted to get that out there, that make sure everybody in my network and my sphere of influence, knows what you do and has the opportunity to connect with you as well.
Wonderful. All right.
Okay.
All right, Josh, let's wrap this interview for today. Again, thanks for allowing me to interview. Thanks for being my interviewee, and I'll see you in Pittsburgh. I'll be in Pittsburgh next week.
Sounds great, man. Looking forward to it. I'll see you then. Safe
right,
travel.
bye-bye.
Have a good one.
Thanks.